and good morning to all of you. This is the first monetary policy review for this year. As you have already seen, the decision of the Monetary Policy Board, which was announced in the morning, the Central Bank of Sri Lanka maintains the policy interest rates at the current levels. Accordingly, the standing deposit facility rate will remain at 9%, and the standing lending facility rate will remain at 10%, and the reserve ratio will remain at 2%. In arriving at this decision, Monetary Policy Board took into account the recent developments and the outlook, both near term and the medium term. Let me briefly present a few facts that were taken into account. On the inflation first, headline inflation, although accelerated in recent months, remains closer to the inflation target of the central bank. As you can clearly see, inflation has come down sharply, and there's a little uptick in recent months. Still, in December, inflation was at 4% level, headline inflation, which is below the target. But in the near term, we expect some rise in inflation. That is mainly due to the domestic price adjustments because of VAT amendments and the elimination of certain VAT exemptions. And also we have seen some disruptions to domestic food supply due to weather disruptions. And also we see some dissipation of the favorable base effect that we had last year. Another thing to note is that the core inflation, which indicates the demand pressures of the economy, which is very subdued now at 0.6% in December. Over the medium term, we expect no demand pressures rising. Therefore, the inflation will remain at target level, the central bank at 5% over the medium term. That is mainly because of the very subdued underlying demand conditions due to tight monetary conditions and the tight fiscal conditions. But in the near term, as you see here, till perhaps third quarter of this year, inflation will keep rising. This is mainly due to the VAT changes, which is one-off adjustment, and some disruption to supply side conditions, which we also think that would not persist in the medium term. So in response to the monetary policy measures that have been taken thus far, the market interest rates have been adjusting downwards across the board. You see all lending rates and the deposit rates have come down along with the policy rate changes. But we see further space for the interest rates to come down, particularly the lending interest rates and the government securities yields. The Monetary Policy Board views that there's further space for rates to come down given the current level of monetary policy rates and the time it takes for the transmission of monetary policy measures that have been taken thus far into the money market interest rates. Another development that we see in response to the eased monetary conditions is the expansion of credit to the private sector. We see on month basis, there's a continuous expansion since June last year. So that trend will continue going forward, reflecting the recovery of activity of the economy as well as the reduction in lending interest rates. So we will expect further impetus from this expansion of credit to economic activity going forward. Activity has picked up in Q3, which showed a positive growth of 1.6% after 6 quarters of contractions. Again, we expect this momentum to continue in the quarters ahead. A little larger expansion of activity in Q4 expected, and the same momentum will continue this year as well. And this will be supported by a few factors, including the faster pass-through of relaxed monetary policy interest rates to broader market interest rates. And we have seen firming of credit demand. And again, we have seen some improvements in the business and investor sentiment despite some setback due to VAT amendments that were in place from January. And also we will expect some improvements in the supply conditions, plus the gradual rebound of expected demand from global partners. On the trade front, we have seen a reduction in the trade deficit to lower levels since 2010. That is mainly reflecting the subdued import demand due to on the one hand, there was some import restriction measures last year, but on the other hand, there was overall moderation of activity as well. So last year, the trade deficit would be about $4.9 billion, which is quite lower than the other years that we have seen in recent years. And this year also, we expect some modest level of trade deficit, but little expansion due to the recovery of activity and due to the recovery of import demand gradually during the current year. And other factors which are helping the current account of the balance of payments are mainly the workers' remittances and the earnings from tourism. Workers' remittances have recovered quite notably, recording above $500 million a month in recent months. So we expect the same momentum to continue. So last year, we have had about $6 billion as workers' remittances, and the same level or even a bit more can be expected in the current year. And the tourist arrivals have almost normalized. As you see here, the January forecast, which is indicated in the red dot here, about 200,000 arrivals, which is almost the sort of pre-crisis level of monthly arrivals. So we will see the tourist arrivals being sort of supporting the earnings in the tourism sector, which will be cushioning the current account balance going forward. So last year, we had about $2 billion as earning from tourism sector. So because of sort of benign conditions in the domestic forex market, with more inflows and the current account surplus as well, and also our purchases from the domestic foreign exchange market, with some assistance from the multilateral lending agencies, we've been able to build up reserves to $4.4 billion by end of last year. And reflecting these effects on the exchange rate, we have seen an appreciation of last year, 12.1%, and the same appreciation trend has continued thus far during the year as well. Rupee remains at about 320 level at the moment. So with that, let me conclude the presentation by sharing this message from the board. The Monetary Policy Board was of the view that there's space for market interest rates to continue to come down in line with the past monetary policy measures and falling risk premium of common securities. So the board anticipates a broad-based reduction in overall market lending interest rates in line with the monetary policy measures effected since June last year.